Hey everyone, and welcome. I'm Samer Herakli, and today we're diving into a comprehensive explainer on a seriously high-stakes area of any business, the Treasury Audit. At its core, a Treasury audit is all about ensuring an organization's funds are managed efficiently, adequately safeguarded, and actually used to achieve business objectives, all while playing by the rules, laws, and best practices. Consider that our North Star for today's masterclass. To get there, we're going to follow this complete roadmap. Treasury audits are incredibly complex ecosystems with a ton of moving parts. But don't worry, by the end of this explainer, you're going to have an unshakable understanding of how all these pieces fit together. We're going to walk through this chronological guide step by step so you understand exactly how the Treasury operates and, more importantly, how it's audited. Our agenda for today is straightforward. We'll hit the definition and objectives, then the Treasury function and areas. After that, we'll cover governance and key risks, the Treasury audit lifecycle, connectivity, and common red flags, and finally wrap up with key controls and takeaways. All right, kicking things off with Section 1, Definition and Objectives. Let's get our foundation set. A Treasury audit is, fundamentally, an independent evaluation of Treasury activities and controls to ensure effective management and minimized risks. We have to be absolutely sure that cash, funding, investments, foreign exchange, and liquidity are running like a well-oiled machine, and that the reporting is bulletproof. The key word here is independent. Think about a massive multinational company dealing in a dozen currencies. Management might be totally convinced their foreign exchange hedging strategy is genius, but they still need an independent auditor to step in, verify those hedging activities, and confirm they aren't accidentally exposing the company to massive currency risks. So why do we actually do this? Well, the objectives are pretty clear. First, we have to ensure the safeguarding of funds and assets, literally making sure the cash isn't walking out the back door. We also ensure liquidity and solvency. Liquidity is having the short-term cash to make payroll next week, while solvency means having the long-term strength to survive for decades. We also need to ensure compliance with policies, laws, and regulations, guarantee the accuracy of reporting, identify risks, and optimize returns to minimize costs. Ultimately, it's the whole shebang of preventing fraud, errors, and catastrophic losses. Moving right along to Section 2, Treasury function and areas. Let's talk about what these teams actually do day to day. You can really think of the Treasury Department as the beating heart of the company. It's the central hub interacting with banks, cash, loans, investments, and forex. Money and data are constantly flowing back and forth between the Treasury and all these internal and external elements. Literally, nothing in a business happens in isolation from this hub. Breaking that hub down, there are 5 distinct Treasury areas we audit. First up is cash management, handling inflows, outflows, and bank accounts. Think verifying the daily cash registers against actual bank deposits. Then, borrowings management, where the Treasury secures and monitors short and long-term loans. Imagine negotiating a massive syndicated loan for a new factory. Next is investments management, ensuring surplus cash isn't just sitting there, but is put into approved instruments for optimum return. Forex management is huge for global firms, handling foreign currency and hedging, locking in a specific exchange rate today to buy supplies from Europe 6 months from now. And finally, liquidity management, ensuring there's always enough cash on hand to meet immediate obligations. Which brings us to Section 3, Governance and Key Risks. Structure meets threats. Look, to handle these massive functions and securely move millions of dollars around, governance has to flow top-down. The ultimate authority sits right at the top with the board of directors, who delegate oversight to the audit committee. Below that, we have the codified rulebook, the Treasury policy and guidelines. These rules dictate the actions of the Treasury Committee, sometimes called the Asset and Liability Committee, or ALCO. Finally, this committee directs the highly specialized teams on the ground, Treasury operations, risk management, and Treasury accounting. It's a very strict chain of command. And to make that hierarchy actually function, you absolutely need strict governance requirements. We're talking defined roles and responsibilities, clear delegation of authority, independent oversight and review, and regular reporting and compliance monitoring. Let me zero in on clear delegation of authority for a second, because it is totally non-negotiable. Without it, a single mid-level employee could theoretically authorize the transfer of massive sums of company cash to an offshore account completely unchecked. The authority to move funds has to be rigidly tiered. Now, what happens when things go sideways in that structure? The risks are severe. We're looking at things like cash shortages or, conversely, excess idle cash, which just means money isn't working for the business. You got the risk of inaccurate cash forecasting, unauthorized or fraudulent transactions, poor segregation of duties, duplicate payments, and high borrowing costs. And let me tell you, inaccurate bank reconciliations are incredibly dangerous. If reconciliations are sloppy or manipulated, they can easily hide massive systemic losses or ongoing fraud for months before anyone even notices. Beyond the daily cash issues, we have larger structural risks. Covenant noncompliance, wrong interest calculations, improper or unauthorized investments, forex rate fluctuations, liquidity risk, and inadequate reporting and monitoring. Let's talk about covenant noncompliance for a moment, because it's a huge deal. Imagine a company borrows $10 million, and the bank sets a covenant stating the company's debt-to-equity ratio cannot exceed a certain limit. If the Treasury mismanages funds and breaches that ratio, the bank could legally call in the entire loan immediately. That could bankrupt the business overnight. So how do we actually investigate this? That's Section 4, the Treasury Audit Lifecycle. When conducting the audit, you follow a precise 5-step lifecycle. Step 1 is planning. You have to understand the processes, the scope, the policies, the systems, and the regulations. Step 2 is risk assessment, where you figure out exactly where the enterprise is vulnerable so you can prioritize your focus. Step 3 is testing and evaluation. This is where you roll up your sleeves, test controls, verify transactions, and analyze exceptions. Step 4 is reporting, communicating your findings, and formulating a rock-solid management action plan. Finally, Step 5 is the follow-up. You track the action plan and retest the controls to ensure those vulnerabilities are officially closed. Next is Section 5, connectivity and red flags, learning to spot the warning signs. Auditing the Treasury requires a very sharp eye for connectivity. Remember, the Treasury Department acts as the central hub connecting various financial activities. Because it's a fully interconnected web, a failure in the Treasury doesn't just stay in the Treasury. It ripples out immediately to cash flow, bank relationships, loans, investments, reporting, and forex operations. You have to know exactly where those connections might snap. Because of that immense connectivity, auditors have to be hyper-vigilant for common red flags. These are your warning sirens. We're talking frequent bank reconciliation differences, large idle cash balances, delays in payments or collections, unauthorized bank accounts, unusual or high-value transactions, covenant breaches, and manual overrides and adjustments. Let's say you're auditing an automated accounting system and you suddenly see a user inputting a manual override to push through a massive wire transfer, bypassing the usual system checks. That is a massive red flag. Why did the system block it? Why did the user bypass it? As an auditor, you have to hunt that down immediately. Finally, Section 6, controls and key takeaways, how we fix the problems and add value. To cure those red flags and mitigate the risks, we rely on key controls. This means ensuring segregation of duties, dual authorization for payments and investments, daily bank reconciliations, strict Treasury policies and limits, cash forecasting and monitoring, rigorous investment and borrowing approvals, system access controls with audit trails, and regular reporting to management. Dual authorization and system access controls are absolute game changers here. If one person enters a payment into the system, a completely different person with different access credentials must approve it. Just segregating those duties stops the vast majority of internal Treasury fraud dead in its tracks. Every single control we test connects back to one ultimate takeaway. A strong Treasury audit ensures liquidity, protects the organization's funds, optimizes returns, manages financial risks, strengthens controls, ensures compliance, and supports effective financial governance and decision-making. At the end of the day, this is about the survival and prosperity of the entire organization. I want to leave you with this foundational equation. Remember, effective Treasury management equals liquidity plus control plus compliance plus risk management plus value creation. That is the true essence of our work. But ask yourself right now, based on the controls we've discussed today, is your organization's Treasury a fortified vault or a house of cards just waiting for the next market breeze? Thank you so much for joining this explainer. I'm Sameh Herakli, and I will see you next time.